Something happened overnight, and almost nobody in the financial media is going to explain it to you properly. So I need you to do one thing right now. Pay close attention, because what I'm about to show you isn't one event. It's 4 separate events that all happen inside the same 48-hour window. And once you see how they connect, you'll understand why the next 10 days could be the most important 10 days the silver market has seen in decades. Because this isn't normal volatility. This isn't just another dip. This is what it looks like when the paper market starts losing control and the physical market starts telling the truth. Let's get into it. First, silver's volatility index just exploded by nearly 60% in a single session. Second, a headline is now spreading across Bloomberg terminals and financial media that looks like it was designed to move markets. Third, the Shanghai physical silver market is now pricing silver almost 20% above its own paper contracts. And fourth, the Federal Reserve just injected $16 billion into the banking system through overnight repos, the second largest liquidity injection since the crisis era. Now listen carefully. These are not random events. These are pressure points. And when pressure points show up this close together inside this tide of time window, it usually means something behind the scenes is breaking. And by the end of this video, you're going to see exactly why all of these things are connected and why the timing, just 10 days before COMEX first notice day on February 27th, is not a coincidence. Let's start with the volatility explosion, because this is the one number that should have every serious silver investor wide awake right now. The CME Group publishes a volatility index for silver called Cvol. It measures 30-day implied volatility derived from options on silver futures. In simple words, it tells you how violent of a move the options market is expecting in silver over the next 30 days. When Cvol is in the teens or 20s, the market expects calm. When it hits the 40s or 50s, things start getting interesting. But when it breaks above 100, that's when something extreme is expected. And as of 2:28 a.m. Central Time on February 17th, silver's Cvol hit 115.56, up over 42 points from the previous session. That's a near 60% spike overnight in a single session. Let me put this in perspective. When silver hit its all-time high of $121, the Cvol was lower than it is right now. Let me say that again because it matters. The volatility index is now higher than it was at the all-time high. That means the options market is pricing in a bigger move from $74 than it priced in from $121. Think about how insane that is. That means the smartest money in the room, institutional traders, hedge funds, banks that trade silver options, are collectively saying that what's coming in the next 30 days is going to be more violent than the move that took silver to its all-time high. Now the market doesn't specify direction. It doesn't tell you if the move is up or down. But it tells you one thing clearly. The magnitude is expected to be historic. And I'm going to be honest with you. When I pulled up that number at 2:30 in the morning, I stared at it for a full minute. Because this isn't supposed to happen. Volatility is supposed to be highest at the peak, not after a crash. Volatility is supposed to cool down after a 50% wipeout. But instead, options traders are more nervous now than they were at $121. That tells me something fundamental changed. Something broke. And the market knows it, even if the media won't say it. Welcome to the hidden economy. If you're new here, subscribe and drop a like. One click from you helps thousands more people see what's really happening. Now, that was the first event. Here's the second. A piece is now circulating across Bloomberg terminals and financial media, featuring James Thorne, the chief market strategist at Wellington Altus. It started as a post on X. Then Benzinga picked it up. Now it's being summarized on Bloomberg terminals. And the headline is designed to provoke. Bitcoin is a bet on Trump's success. Gold is a bet on America's failure. Let's break down what he actually said. Because the headline is meant to trigger emotion. But the substance underneath it is a warning. Thorne's argument is basically this. If you're buying gold, you're betting America cannot grow its way out of its debt. That the only path forward is printing, debasing, and hoping the system doesn't collapse. Gold becomes a verdict, a confession. that the system is beyond repair. And if you're buying Bitcoin, you're betting Trump's economic program works. That deregulation, capital redirection, and growth can shrink the real burden of debt without printing it away. Bitcoin becomes the flag of reform. And Thorne claims both cannot be right at the same time. One of them has to be wrong. And he says the next 2 years will determine which verdict was correct. Now here's the part that matters. The most important part of that entire piece is what he didn't say. He didn't mention silver. And that omission is everything. Because silver doesn't fit into their neat little political narrative. Gold is seen as a monetary bet. Bitcoin is seen as a political bet. But silver? Silver is a monetary metal and an industrial necessity at the same time. Solar panels, electric vehicles, semiconductors, 5G infrastructure, data centers, military hardware, medical equipment. Silver doesn't care who wins elections. Silver gets consumed regardless. So when they frame the debate as Bitcoin versus gold, they are deliberately excluding the one asset that breaks their entire framework. Because silver is both. It's a bet on monetary instability and a bet on technological expansion at the same time. And here's something that destroys Thorne's argument completely. Look at what gold is doing versus Bitcoin right now. Gold is near all-time highs. Bitcoin is struggling. If Bitcoin is a bet on Trump's success and gold is a bet on America's failure, then the market is voting overwhelmingly for failure. Central banks bought over 1,000 tons of gold last year. They bought 0 Bitcoin. Sovereign wealth funds are accumulating gold, not Bitcoin. And the gold-to-silver ratio has been compressing, which historically signals the late stage of a precious metals bull market, where silver dramatically outperforms. So Thorne says gold holders face steep losses if Trump succeeds. But gold has outperformed the S&P 500, Bitcoin, bonds, real estate, and almost every major asset class over the past year. If gold is wrong, it's the most profitable wrong bet in the world right now. And if gold is right, if America really is drowning in debt with no way out except debasement, then silver at $74, while physical is trading near $100, is one of the most mispriced assets on the planet. Now here's what makes the timing of this piece suspicious. It drops the same week silver volatility explodes to levels higher than the all-time high. The same week COMEX has 10 days until first notice day, with 98 million ounces of registered silver, against 400 million ounces of March open interest. The same week Chinese markets are closed for Lunar New Year. And the same week the Fed injects $16 billion into the banking system. So let me say this clearly. When Wall Street circulates a politically charged headline about gold being anti-American during the exact week silver is showing historic stress, that doesn't feel like journalism. That feels like narrative management. They want precious metals investors to feel shame. They want people to hesitate. They want capital flow into physical metal to slow down. At the exact moment the physical market is screaming there isn't enough metal to go around. Now, let's move to the third piece of the puzzle, China, because this is where the paper market story starts falling apart completely. Shanghai has multiple silver contracts. One is basically a paper bet. One is a standard futures contract. And one is physical, real metal. 99.99% pure. Delivery. Now here's where it gets crazy. The paper contract is trading around $89. The futures contract is around $92. But the physical contract, actual metal, is trading around $99.73. That is nearly a 20% premium. Let that sink in. Physical silver in China is trading near $100, while COMEX paper spot is trading near $74. That's a $25 gap. I want you to understand what this means. This is not a normal premium. This is not shipping costs. This is not temporary demand. This is two different realities, two different worlds. One of them is lying. And here's the detail that tells the whole story. Even inside China itself, physical is about $10 higher than paper. That means even the Chinese paper market is being forced to admit silver is scarce, when physical trades at a huge premium to paper within the same exchange system. The paper price is fake. The physical market is telling the truth. And the truth is simple. Silver is not $74. Silver is whatever price you have to pay to actually get your hands on it. And right now, in Shanghai, that price is close to $100. Now, why does this matter? Because Chinese markets are closed this week for Lunar New Year. Shanghai Gold Exchange is closed. Shanghai Futures Exchange is closed. The biggest physical buying machine on Earth is offline. And every time China goes dark, Western exchanges historically use the window to press prices lower. We've seen it before. We're seeing it again. Silver is down as I'm recording this, trading in the low $70s. But here's what most people don't realize. This creates the biggest physical arbitrage opportunity in years. Because when China reopens, they're going to look at Western prices and see silver $25 cheaper than their own physical market. And if you think Chinese industrial buyers and refiners are going to ignore that, you don't understand how this game works. This is why I'm watching most closely. Because China reopens on February 24th, and COMEX first notice day is February 27th. That's a 3-day window. 3 days where physical demand can collide with delivery obligations. Right when the paper system is already under maximum stress. Now, I'm not predicting exactly what happens, but I am telling you, I have never seen this many pressure points converge in the same week. Now, let's go to the fourth event, the Federal Reserve, because this is the part nobody wants to talk about. The Fed injected $16 billion into the U.S. banking system through overnight repurchase agreements. This was one of the largest liquidity injections since crisis-era operations. And it wasn't just the injection. The New York Fed also removed the aggregate operational limit on its standing overnight repo facility, meaning there is no longer a cap on how much emergency cash it will provide. Think about what that means. The central bank looked at the banking system and decided not only did it need emergency cash, but the safety limit on emergency lending needed to be removed entirely. They removed the cap because they expect the cash calls to get bigger. Now here's the pattern that should scare you. Emergency cash infusions started months ago. Huge amounts. Halloween, after Christmas, December 28th, December 30th. Over $100 billion in emergency overnight funding in roughly 2 months. And every time, right after these injections, the CME announces margin requirement changes for precious metals. Let me say that again. The Fed injects emergency cash into banks, and then the CME hikes margins on silver and gold. Over and over. Like clockwork. That pushes prices down. It reduces stress on short positions. It buys time. Now you can call it coincidence. But at some point, the pattern becomes too obvious to ignore. And here's the connection almost nobody is making. JP Morgan, the same bank that stood for maximum silver delivery at the exact bottom of the January crash, is right at the center of this system. And one of JP Morgan's units disclosed short positions of approximately 5,900 tons of silver it does not own. That is a naked short. And a naked short creates unlimited loss exposure if silver rises. So ask yourself, if banks are massively short silver, and silver volatility is exploding, and physical silver is trading $25 higher in Shanghai, and COMEX is approaching first notice day, what do you think happens to margin calls? They explode. And where does the cash come from? It comes from the Fed. The Fed isn't injecting liquidity to help you. They're injecting liquidity to keep the institutions that are short precious metals from blowing up. Because if one of them fails, the domino effect would be catastrophic. Now let's connect all 4 dots. Silver Cvol exploding above 115 means the options market expects a historic move in the next 30 days. That 30-day window includes Chinese reopening, COMEX first notice day, and the entire March delivery cycle. A politically charged headline spreads across Bloomberg, framing gold as anti-American. During the exact week, silver is showing historic physical stress. That looks like narrative management. Shanghai physical silver trading near $100 while COMEX paper trades near $74. Shows the physical market has divorced from the paper market. And the Fed injecting billions in emergency cash and removing limits on future lending. tells you the banking system is under stress. All of these events happened within 48 hours, and they all point to one conclusion. The system is under more stress now than it was before the January crash. And the January crash was the most violent precious metals event in decades. So here's what I think is really happening. I don't think the January crash was a normal correction. I think it was a rescue operation. Banks were facing delivery obligations they couldn't meet. The CME engineered a crash through margin hikes. JP Morgan took delivery at the bottom. The Fed provided emergency cash. And now, the financial media is providing narrative cover, framing precious metals as a bet against America, to slow down the flow of capital into physical metal. But here's the problem. The crash didn't fix the underlying issue. COMEX has fewer ounces today than it had before. Shanghai has a bigger premium today than it had before. Delivery rates are still extreme. And volatility is higher now than it was at the all-time high. The crash bought time, but it didn't solve the shortage. If anything, it made the shortage worse, because the crash made physical silver cheaper in the West, while demand in the East stayed the same. So metal flowed east even faster. Now I know what some of you are thinking. If all of this is true, why is the silver price going down right now? Fair question. And the answer is simple. The paper price and the physical price are no longer the same thing. When you see silver quoted at $1.74, you're seeing the price of contract, a promise, a piece of paper that says someone will deliver silver in the future. But when Chinese buyers pay near $100, they're paying for metal, real silver, in their hands. Paper can be created infinitely. Physical cannot. You can print dollars. You can print contracts. You can print narratives. But you cannot print silver. And that's why this matters. Because the world has been running a massive silver deficit for years. Month after month. Year after year. And at some point, the paper market and the physical market have to reconcile. Either paper prices rise to match physical reality, or the paper market loses credibility and becomes irrelevant. Either way, the people holding physical metal win. And the people holding paper promises are at the mercy of exchanges that have already proven they will change rules, hike margins, cancel trades, and invoke force majeure when it benefits them. So here's my assessment going into what could be the most critical 10 days of this entire silver cycle. Cvol above 115 says something massive is coming. The direction could be up or down, but the magnitude will be historic. Shanghai physical premiums say the real price of silver is not $74. It's closer to $100. The Fed injection says banks need emergency cash to survive margin calls. The gold is anti-American narrative says the establishment wants you to hesitate. And the calendar says first notice day is right around the corner. Now, in more detail before I end this. JP Morgan's own research team just published their 2026 silver forecast. They see silver averaging $81 per ounce this year. Let me make sure you caught how insane that is. The same bank that is short thousands of tons of silver is telling its clients silver is going up. Either their research team has no idea what their trading desk is doing, or they know exactly where this is headed, and they're positioning for both outcomes. You decide which is more likely. Drop a comment and tell me what you think the Cvol spike is signaling. Crash or squeeze? I want to hear your take, and I'll pin the best responses. And share this video with one person who needs to see the Shanghai premium data. Because most people have no idea physical silver is trading $25 above paper. That single fact changes everything about how you should think about the silver market right now. If you're not subscribed, hit that button now. I'm connecting dots every day that nobody else on YouTube is connecting. Stay sharp. Stay stacking.